there is a shift going on here. And I think we could be at a major inflection point in terms of the market's focus. And again, won't be just the Mag 7. In fact, the Mag 7 can start to lag other areas of the market, which would have implications for the S&P 500 because 40% of the S&P is in 10 stocks. Will NVIDIA sell less chips? Tesla's auto business had some cracks in their last quarter. And I'm not trying to downplay their businesses. What I'm really more saying is their stock market dominance, I think, is coming to an end.
Peter Boockvar returns to the show today. He is a CIO of Bleakley Financial Group. Lots to go over today, Peter. We want to talk about the DOGE program that's underway. We're going to talk about the evolution of trade policies from Trump. We'll talk about earnings. We'll talk about the tech trade, which you told me offline may be over, and just generally the major risks and opportunities for investors for the remainder of the year. Welcome back to the show, Peter. Good to see you.
Thanks for having me. David, good to see you as well.
Let's take a look at my screen. Let's start with this piece of news here. Trump says DOGE could return 20% of its savings directly to taxpayers. That could reignite inflation. I mean, that's from this article in CNN. I'll ask you if it's going to reignite inflation. Let's take a look at what was discussed. Trump said he's considering a plan that would give 20% of savings identified by Musk's DOGE back to Americans, potentially complicating the country's ongoing battle with elevated inflation. There's even under consideration a new concept where we give 20% of the DOGE savings to American citizens and 20% goes to paying down debt. The idea of the so-called DOGE dividend, a check sent to every taxpayer and funded with DOGE savings, was publicly floated on Tuesday by a user on Musk's social media platform. This sounds a lot like a stimulus check, doesn't it? What's your view?
Yeah, exactly what it would be. It would be one time, though. Wouldn't necessarily be an ongoing thing, I don't think. Or maybe it is, but it would be a tax cut. I would prefer that they save the spending cuts for the extension of the expiring tax cuts this year, rather than this one-time thing. But maybe it's not one time. I don't know. But yeah, if there's not enough supply for stuff to meet a pickup in demand that these checks would create, then yeah, it would lead to another bout of inflation. So. Sounds good. I'd love a $5,000 check, as I'm assuming everybody would, but I think we need to think broadly about it.
The savings that the DOGE program is claiming to make, it's now in the billions. What impact, if any, is that going to have on, first of all, the deficit, which Scott Bessent, Treasury Secretary Scott Bessent, wants to reduce to 3% of GDP, and second, on economic growth, if indeed that markets were not the markets, but the government is a lot more efficient and saves more money. Any market impact whatsoever?
Well, I think over time, it's definitely going to be a good thing if the government is spending less money and more money is left in the private sector. I think what DOGE is uncovering is great in exposing a lot of the inefficiencies and the waste that the government has, because there's very little accountability in government. But in the short term, we have to understand that any reduction in the U.S. budget deficit relative to GDP, while it is very well needed from a big picture, long-term perspective, it does have negative economic implications. We have to understand that the U.S. economy right now is being held on the shoulders of upper income spending, AI spend, and government spending. The government spending directly or via the IRA or the CHIPS Act or infrastructure spending has been a huge boost to economic activity. Also, looking out over many years, government budget deficits has been a corporate surplus in the private sector. So if there's going to be less of a budget deficit, again, good thing long term, but in the short term, that can be less corporate profits. So it's just like a drug addict that needs to get clean. Getting clean is a good thing, but there could be a withdrawal period that could be painful.
This is my screen once more. CME Fed Watch tool. The probability of a cut by the next meeting, basically nil. Cut by May, a little bit higher, but still not significant. It's not until June that we see a higher probability of a 25 basis point cut. The markets, like the Fed perhaps, are anticipating inflation to stay stickier, hence the lower probability of a cut before June. What's your read on inflation? Is inflation going to remain sticky, do you think?
Well, I think on the services side, we could see further moderation as lower rent growth works its way into that calculation. I do think that rents will resume their upward trend next year, but at least for the next 6 months, we could see deceleration there. On the flip side, though, it does seem that and there's some mitigants to that, so it's not necessarily going to be clean. Services inflation has been buoyed by motor vehicle maintenance costs, motor vehicle insurance, airline fares, and other things. On the good side, that's where most of the disinflation has taken place over the last couple of years, and I'm beginning to see signs of a bottoming out. We've used car sale prices that are lifting again. Huntsman, a big chemical company in the U.S., talked about on their conference call this week about possibly raising prices on a few of their chemicals. So I do think that while inflation, looking out over the next couple of quarters, could decelerate in the aggregate, I don't think it's going to be by much. And I do think you throw in the prospects of tariffs, even though some will argue that it's a one-time impact, that there is enough muddiness in the data for the Fed to have no confidence at all right now about what they're going to do with rates. I mean, one of the precursors of Powell cutting interest rates last year was he wanted to have confidence in the trajectory of inflation. Well, I don't think he can have any confidence in a further deceleration in the trajectory of inflation. And that's why I think they're going to sit on their hands, at least for the next few meetings.
Before we continue with the video, I'd like to tell you about the precious metals sector. Now, gold, as you know, hit record highs. So the question on everybody's minds is, what should we be following and tracking in relation to gold? Well, I'm here to tell you that Stellar Gold is a name to watch. Stellar is a leading gold developer with 2 cornerstone gold projects in Canada: the Tower Gold Project in the prolific Timmins mining camp, and the Kalamak Gold Project in the Northwest Territories. The company has a massive global mineral resource estimate, one of the largest in Canada for a gold developer. Its young and ambitious management team, with a track record of success, is aggressively advancing its projects and is determined to unlock significant value. If you're looking for a team who is as enthusiastic about gold's future as you are, then check out stlrgold.com/David Lin in the link down below, or scan the QR code here, where David Lin viewers can sign up for their macro gold newsletter to get inside knowledge and updates for free. Let's talk about economic growth now. On Thursday, the LEI leading economic index came out unexpectedly decreases in January, reversing most of the gains for the previous 2 months. The Conference Board released a report on Thursday showing an unexpected decrease by its reading on leading U.S. economic indicators in the month of January. Conference Board says leading economic index fell by 0.3% in January, following a revised 0.1% uptick in December. Now, I know this is just 1 month, but are you seeing other signs that may perhaps point to a slowdown in economic growth, Peter?
Well, I talked about the strength of the economy being in upper income spending, AI spend, and anything related to the government. But the flip side of that, and this all points to what I have referred to as a very mixed and uneven economy, is lower to middle income spending has been more muted, particularly in the lower end, as people deal with the cumulative rise in inflation and prioritize things that they need rather than things that they want. The pace of existing home sales is at a 30-year low. Manufacturing has been in a recession for more than 2 years now. Global trade is relatively muted. And with respect to the labor market, on one hand, the positive is the pace of firings has been relatively muted. Obviously, we're now beginning to see it in D.C., Maryland, and Virginia, of course. But the pace of hirings, has slowed and has been more subdued relative to the last couple of years. So I think all in all, as I said, it's a very mixed and uneven economy right now.
Okay. Well, the markets have taken a bit of a slide earlier today on the trading session. The Dow is down about 80 basis points. The S&P is down about the same. Dow down 500 basis points. Walmart forecast raises concern about earnings. Stocks dropped on Thursday. Dow member Walmart dropped more than 6% after the company said it expects fiscal year sales to grow between 3% and 4%, which I guess is a disappointment to some. If Walmart is given the bad guidance, you should be paying attention to it. says this particular analyst Tom Fitzpatrick, managing director at RJ O'Brien Associates. Okay, so Walmart, one of the largest retailers in the nation, in the world, arguably, dropping more than 6% on the day. What does that signal to you, if anything?
Well, I think yes, their guidance was a touch light, but overall the number was fine. I think the problem with Walmart is more so the stock than the company itself. The stock went into the numbers release trading at 38 times earnings, and there are a bunch of stocks like this trading at crazy multiples. I mean, Costco's trading at 60 times earnings. Phenomenal business, but a nutty multiple. And we've seen that in a variety of other stocks. And there is a common theme on the day that we're taping this of a lot of these high multiple stocks are getting hit. It was a momentum trade that took them to tremendously elevated levels. And I think the Walmart news, I guess maybe it's just a wake-up call. Whether this is the beginning of something more, we'll have to see. But all these momentum stocks, all these comfort stocks, including the Mag 7, really sucked a lot of the stock market energy away from everything else and into these names. And what we're seeing is a tremendous rotation taking place. International stocks and other names outside of these momentum stocks that have just been tremendous to the upside.
Okay, well, the other piece of news we should discuss is perhaps tech. Now, you told me offline the tech trade is over. Before we get into specific new developments within the tech space, curious to get your thoughts on that and what you mean by that.
Well, I specifically mean the Mag 7. And when I say over, I'm talking in terms of their dominance relative to everything else, where there was just a one decision trade and to buy these 7 stocks. And I think that there is some reality check to their fundamentals and potentially their growth rates, and that maybe some of these businesses transition to more value stocks than growth. Whether it's the DeepSeek news that definitely caused a lot of people to question, and this questioning actually started last year in terms of all this hyperscaler spend and what the revenue drivers will be from that spend. And the DeepSeek certainly brought it front and center. And then you wonder, okay, what's AI's influence on Google's search business, for example? Should I be paying 33 times earnings for Apple stock that doesn't really grow anymore in terms of its growth rate? Will NVIDIA sell less chips because of the ability to do things cheaper, even though not at least right now, because the hyperscalers are still spending an extraordinary amount of money. Tesla's auto business had some cracks in their last quarter. Now, again, these are all great companies, and I'm not trying to downplay their businesses. What I'm really more saying is their stock market dominance, I think, is coming to an end. And then you look at Europe, for example, which is their performance is double the S&P this year. And that Europe seems to be coming to a Jesus moment that they themselves have been their own worst enemy in terms of crimping economic activity through their bureaucracy, their red tape, their welfare state. And maybe they're beginning to see the error of their ways. And we're beginning to see that from some European leaders realizing that. They have to spend a lot of money on defense. So that is going to boost European defense stocks. We're seeing the AI trade in China now taking form. Alibaba up 10% on a good earnings report following good performance in some of the other big tech stocks in China. So there is a shift going on here. And I think we could be at a major inflection point in terms of the market's focus. And again, won't be just the Mag 7. In fact, the Mag 7 can start to lag other areas of the market, which would have implications for the S&P 500 because 40% of the S&P is in 10 stocks.
So if I understand correctly, are you saying that we're potentially going to see capital flight away from the Mag 7 into competitors in Asia, perhaps even in Europe? Is that what's going to happen next quarter?
I think it can be that. I think it can be rotation into small mid-cap stocks too. But there are also bigger implications if this is going to take place because foreigner, let's just take the foreign investor. They have, or even the foreign central bank. The foreign central bank has reserves that they allocate into different things. They allocate it into other foreign currencies. They allocate it into other foreign bond markets, particularly U.S. Treasuries. They own gold. And I think that U.S. tech stocks, the Mag 7, have become a reserve holding of many foreigners and some foreign central banks. The 10th largest holder of NVIDIA is Norges Bank. Norges Bank, the central bank of Norway, that owns about 325 million shares of NVIDIA, to use that as the example I'm giving. The Swiss National Bank, that prints money out of thin air to buy stocks, they own about 70 million shares of NVIDIA. It has become a reserve asset for some of these countries. Well, if this trade is sort of tiring out, well, what happens if foreigners start to reallocate some of this capital into other things, maybe outside the US? Does that also have implications for the US dollar? Which then take that one step further. The Trump 2.0 that is going through the tariff motions again, one of the mitigant factors on tariffing other countries is having a strong dollar. Well, what happens if the dollar doesn't stay so strong because of other factors like the tech trade ending and the dollar after this extraordinary rally since November starts to peter out? Well, we lose that mitigant factor of putting on tariffs on other countries. So I think there's a lot to this tech trade unwind if it were to take place, if I am right that it's possibly sort of ending in its dominance. So I think that these are just things that we should all be thinking about as global investors.
Does the end of this tech dominance, suppose it does happen, does that mean a rotation into other asset classes like bonds, or does that mean a decline in most asset classes like what we saw in 2022 when bonds and gold and stocks all did poorly?
Well, I don't know yet. I think right now we're seeing rotation into other markets internationally, Europe and parts of Asia. The Russell 2000, to use that as an example of maybe rotation to the U.S., not really seeing that just yet. But within the S&P, there is some sort of shifting around. I mean, bank stocks have traded really well over the last couple of months, so that's sort of taken the baton, at least short term, from U.S. tech stocks. So whether this drags down the whole market, I don't want to say just yet. But I think right now it's at least some of this money is finding new homes.
Okay, I'd like to respond to this tweet by the CEO of Microsoft made earlier yesterday, actually. So, after a nearly 20-year pursuit, we've created an entirely new state of matter, unlocked by a new class of materials, topple conductors, that enable a fundamental leap in computing. We believe this breakthrough will allow us to create a truly meaningful quantum computer, not in decades, as some have predicted, but in years. Imagine a chip that can fit in the palm of your hand, yet is capable of solving problems that even all the computers on Earth today combined could not. It's not about hyping tech, it's about building technology that truly serves the world. This is what he tweeted earlier, and he's referencing, of course, quantum computers. Is this a game changer for tech, or is it too soon?
I don't know, to be honest. I do think, though, if he's right, it could be, and it also could be very disruptive within tech itself. I mean, think about all the data centers that are being built. Well, if you can sort of shrink the size of the capability of the data center, there's going to be a lot of wasted real estate out there. There's going to be a lot of technological obsolescence on all the data centers that are being built right now. But that's what technology does. It changes. Now, I can be wrong on that. Maybe these data centers can need, or I should say quantum computing may need the current state of this data center build. I don't know enough to say, but I do think it highlights the shrinking of technology in terms of where it can physically be housed, where we went from the mainframe computer down to a cell phone. But tech changes, and this can be just another revolution. And again, back to the Mag 7, the technology that these companies are creating are tremendous, but that doesn't mean that the stocks haven't already priced in a lot of this good news that can lead to a period of underperformance or a dramatic period of outperformance.
Can you just think, as an investor, what applications or how this technology may benefit the consumer, which ultimately is the biggest group of people that gives these companies money? The Mag 7, it's not just the research centers and the defense sectors, although that may be a big part of the revenue. So a computer chip the size of your palm that, per his words, can solve computer problems that will take the entire Earth's computers together to solve today. Uh, does that change the lives of you and me at all? Are we able to monetize that for the regular person?
I mean, I think the user, not necessarily, but I think it will just make our lives easier. Just like I can go to ChatGPT, for an example, and get an answer to a question quicker than I can go to Google, even though Google's using Gemini, for example, or you can go to Perplexity. I mean, that's the history of technology. It makes our lives more efficient, more productive, and sort of quicker in getting the things we want, whether it's getting an information bit or it's getting from New York to LA via an airplane quicker than a horse and buggy or a plane relative to a ship. That's what technology does.
So you're a little bit hesitant or skeptical about the prospects of tech. So what do you like right now? What are you more confident in, asset class or sector wise?
Well, I think an interesting place to be right now is commodities. I talked about Europe, for example. If Europe's economy can start to grow again, the amount of money that Europe's going to spend on defense. Now, you can of course buy European defense stocks, but they've already had nice runs. But the money they're going to spend on defense is going to need steel. It's going to need copper. It's going to need nickel. It's going to need other industrial metals. If the Russia-Ukraine war ends, hopefully soon, imagine the raw materials that are going to be needed to rebuild Ukraine. Israel, Gaza, you're going to hopefully have rebuild Gaza. You're going to have to rebuild parts of Southern California. So I think that the commodity trade could be pretty interesting here. And look at China's economy showing some signs of maybe bottoming, particularly in the real estate side, which has been a disaster for them as the rate of home price declines start to slow. Now, I'm not expecting a resurgence of home building there, but if you can get to a bottom in the housing sector there, maybe that also puts a bottom in some of these industrial metals. So we're bullish on energy. We're long energy stocks, some of the other industrial commodity stocks, copper, precious metals, uranium, and some of the agriculture stocks like fertilizers.
How much of a geopolitical risk premium is baked into energy, or does that not matter? I bring that up because just earlier this week, Putin had a call with Trump. They're beginning their ceasefire negotiations, excluding Ukraine and excluding the European allies, by the way. But that's a different story. The question is whether or not oil will fall if a deal is reached in the next couple of months.
I don't think so. And the reason I say that is because we're 3 years into this war and there's really been no disruptions in the delivery of natural gas and oil because it's fungible. So, yeah, Russia had to pivot to where they sell their natural resources, but China and India were willing to gobble up as much as they could, as well as some other countries. So there's really been no delivery disruptions. Therefore, I don't think that there's any war premium in the price. Now, what happens with Europe buying, natural gas, for example, from Russia again, post any agreement? I don't know. Maybe Germany starts to buy natural gas from Russia again. That can actually then maybe lift the price of energy as Russia gets some customers back. I'm not sure, but I don't really think that there's much geopolitical risk priced in right now.
Interesting. And what of Scott Bessent's plan, or not? It's not just his plan, but the administration's plan to drill, baby, drill, pump out an additional 3 million barrels a day eventually. What does that do for the price, if anything?
Well, as he's not a CEO of an oil company, I don't think he's going to have much influence. The CEO
How
of an
would, yeah,
oil
how would they do that?
they wouldn't. The only thing the administration can really do is sort of ease the tax and regulatory burden on drilling, and maybe hopefully take that as a way to incentivize drilling. But oil companies, natural gas companies, are only going to drill if the price is right, and obviously the administration is not going to be able to affect that. Now, when Dissent said 3 million barrels, it was really barrels equivalent. So if U.S. Companies can drill more natural gas liquids, he'll flow that into the 3 million. But again, it has to be economically sensible to drill more, and only a higher price would bring that, not a lower price.
Let's finish off by talking about the bond market now, Peter. You were on the show a couple months ago highlighting the possibility of higher yields. The 10-year has spiked throughout the beginning of February, especially as tariffs were introduced. And then, as you recall, right after Trump placed tariffs on Mexico and Canada, he reached some sort of agreement tentatively with those countries and then rescinded those tariffs, at least with Canada. And we saw the 10-year fall, we saw the dollar fall. I just wonder whether or not the 10-year is still following growth expectations or it's just a play on the trade war progression. What's your take?
Well, I think it's a combination of things. First of all, I think we're in a bond bear market that's going to last more than just a couple of years. We're in it for a couple of years. I mean, historically, bond bull and bear markets last 20, 30, 40 years. We just came off a 40-year bull market that, like I said, is not going to end in 2 years. Now, one of the benefits to owning long-term treasuries right now is DOGE and maybe hopes that the U.S. government gets its finances back together again. But on the flip side, there are a lot of inflationary pressures that are still out there, and tariffs are going to bring it. I talked about the spending that's going to go on in European defense and the rebuild and possibly the bid under commodity prices. I think I talked about rents decelerating this year, but I think that they're going to pick up next year because there's very little new multifamily being built after the flood we've seen. So, and we're seeing a sell-off in bonds around the world. I mean, look at the Japanese bond market. 10-year JGB yield is at a multi-decade high. The 40-year JGB yield is the highest since this was first issued in like 2008, 2009. So the rise in interest rates is a global thing. It's not just a U.S. thing. And I do think that we're going to be retesting at some point. Not smart enough to know when, but the 5% level that we saw in 2023, I think is going to be retested at some point this year in the 10-year yield.
By the way, the fact that the JGB yield is at a 14-year high and the 10-year yield is not, in fact, it's been coming down since the beginning of the year. What does that signal to you? Are we going to see a reversal of the yen carry trade again?
I don't know what's left of the yen carry trade, to be honest. I mean, the yens have had a nice move here. The yen is now sort of testing this 150 level. So after, last August when it sort of blew up, I really have no idea what's left of it. And maybe with the yen rallying and, no blow-ups right now, until there is one, I guess, tells me that maybe there's not much left in it. I'm not sure. I don't know how to quantify it, to be honest.
Great. Thank you very much for your update, Peter. Where can we learn more from you and Bleakley Financial?
So on the investment side, some people can go to bleakley.com and learn about our wealth management services. On the writing side, I write every day. I have a Substack, and people can go to Substack, type in my name, and see what I write every day.
Right. Well, thank you very much for your market update. Please, for those of us watching, please follow Peter in the links down below, and we'll see you again soon. Thank you, Peter. Take care.
Thanks, David. Appreciate having me.
Thank you for watching. Don't forget to like and subscribe.